Hello friends, welcome to learning sessions, and today in this video we are going to discuss about the 28th and 29th chapter of the RBWM, which is actually related to the taxation and the house finance over there. So do watch this video till end because ये chapters बहुत ज़्यादा important है, and if you want to get all the previous videos of JAIIB RBWM, so simply do subscribe to our channel right now, and also you can be enrolled into the full course videos, chapter wise professor questions, mock test, which is actually available for all the 4 papers just for rupees 1899. So do visit the website jaib.learningsessions.in. The link is also available in the description box below. So let's start the session over here. It's related to housing finance and the tax planning. So when we are basically talking about the housing loans over there, we have already discussed that the charge of mortgage is actually created and that scenario. So the borrower is actually the mortgager. The borrower is a mortgager who will be creating the charge in the name of lender, and the lender is a mortgagee over there, and the loan is actually provided by the lender so that a new house can be constructed or a built up house can be purchased, or it could be for the revamp of the or redo of the house over there, and the borrower actually agrees that the person will be paying the principal amount along with the interest over the predetermined period. Right now, in the case of housing finance, some of the tax benefits are available. Let's have a look at it. So it's related to home loan interest deduction, which is available under section 24B, and also principal repayment deduction that is actually covered under 80C over there, and first time home buyer deduction that is actually available in the 80EE over there. Right now, under the section 24B, if you are basically have taken a loan, let's say case, and further you are actually residing in that particular premises, in that scenario there is a limit of rupees 2 lakh per financial year which can be taken under section 24B for deduction purposes over there. And for the, if you are not residing, and for the it's given on you have particularly have tenants, in that scenario there is no limit specified for that particular scenario. Right, and also whatsoever the principal amount is paid in the EMIs, right, so that is actually covered under the section 80C up to amount of rupees 1.5 lakh per year for deduction purposes. And further, if you're first time home buyer, in that scenario whatsoever the interest is actually allowed you for the deduction purposes, 50,000 above amount is actually allowed. Let's say case the total interest component is 5.64 lakhs for the year, and the principal component is, let's say, 8.34 lakhs for the year. In that scenario, out of the principal component, 1.5 lakh can be taken as a deduction under the section 80C, and from this 5.64 lakh component, the particular 2 lakh component can be taken for deduction purposes under what thing, under 24B if you are residing. And if you are not residing, then there is no upper limit for the deduction. You can be taking the whole amount for the deduction purposes, and if you are residing in the premises, you can be taking 2 lakh for deduction for interest component under 24B, and over and above, if you are a first time home buyer, in that scenario you can be taking 50,000 rupees extra. And also the benefit are going hand on hand when there are multiple borrowers. Let's say case A and B are joint borrowers. Or co-borrowers. In that scenario, A can be taking the benefits of 2 lakh under 24B and 50,000 under 80EE, and for the principal repayment under 80C individually, and also that is applicable for the B person also, right? So that's the part related to it. So I hope that you must have understood. Now let's understand the conditions which are applicable, which must be there in case of the section 24B over there. Right, first of all, the loan has been taken on or after the 1st April 1999. That's the first thing. And for the interest payment of home loan must be taken for a self-occupied property. As I told you, for self-occupied property the limit is up to rupees 2 lakh, and further if it is not self-occupied, then there is no upper limit that can be taken for the deduction purposes. Right, and further, a loan is for purchase or construction of a residential property or as a refinance takeover loan. Right, then this scenario, in all these scenarios, this particular benefit can be taken. And if the property is not acquired or construction is not completed within 5 years, let's say case you took the home loan, but you never completed the construction within 5 periods from the end of the financial year in which the loan was taken. Let's say case you took the loan on 27th of July 2016 over there. Then starting from 1st of April 2017 for next 5 years, if the construction is not completed, then particularly you cannot be taking the benefit. then particularly you cannot be taking the benefit of the same. And further, the tax benefit that was actually available for 2 lakh rupees, that will reduce to 30,000 rupees. That is actually now will be reducing to 30,000 rupees if the construction is not completed within 5 years. That's important, right? And if the loan is actually availed for repair or renewal purposes, only 30,000 rupees of particular deduction can be availed, right? If you're taking for construction purposes or a built up house is purchased, then it is rupees 2 lakh, and for the and also condition is self-occupied. And if it is not self-occupied, then there is no upper limit. But if you are taking the loan and you have not basically constructed the house for the 5 years, and also if the loan is actually for the redo or repair or renewal of the house over there, in that scenario the amount is 30,000 rupees. Okay, so that's the case. And if in the case the property for which the home loan is taken is not self-occupied, as I told you, there is no upper limit has been prescribed, right? That's the important point. Then for the tax benefit under section 80C, I've already told you what it is all about. Now let's understand the conditions. Now the property, the loan must be availed only, it can only be availed, this particular 80C benefit can only be availed if the loan is taken for the construction of the property. If the loan has been taken for the construction of the property or particularly for purchase of home over there, and particularly the construction of home has been completed already. It's not the case. Let's say case you took the loan in 2017. And your construction never completed up to 2019. You cannot be taking the benefit of 80C for these years because the construction was not completed. The certificate of completion has to be obtained, and only after that the benefit of 80C can be obtained, only after the completion. Okay, not before that. And for the reversal of tax benefits availed under 80C, so if a taxpayer sells a property within 5 years, let's say case you took the property in 2017, the construction was completed by 2018, and you were taking the benefit under the 80C over there, and you just sold the property in 2020. So whatsoever the benefits you were taking, so in that scenario, whatsoever the benefits you were taking under the 80C section, those are to be paid back. And further, whatsoever the amount that was deducted under the 80C, that will be accumulated as an income for the current year in which you have sold the property, right? So potential tax liability on that particular amount will rise, right? So that's the case. And further, it's related to tax benefits under section 80EE. Tax benefits under section 80EE. So I have already told you the thing, what it is all about. So what are the conditions for the same? So if you want to take the benefits of another 50,000 rupees in case of 80EE, the first condition is related to that the value of the property should not be greater than 50 lakh rupees. That's the first case. And the home loan amount should not be exceeding the amount of rupees 35 lakh. So value of property should not be exceeding for 50 lakh, and home loan amount should not be exceeding 35 lakh. And further, if the tax benefits here can be claimed till the time of repayment of the loan continues. Okay, so it can be taken till the repayment continues over there, and deduction is applicable on home loan paid for the first home property over only, and not for the second property. And the property can be self-occupied or non-self-occupied. There is no funda related to it. And further, this amount is over and above the amount of interest deduction that has been taken under section 24B over there. Alright, so that's the case. Okay, and as on the date the sanction of the loan, no other house is owned by you. As on the sanction of the home loan, no other house has been taken by you. In that scenario only this particular eligibility would be there. Further, it's related to eligibility for claiming section 80EE. What it is all about: can be claimed only by individual taxpayers. Can only be claimed by individual taxpayers, and section 80EE is applicable on per person basis. I told you, if there are co-borrowers, in that scenario the deduction can for all the three sections 80EE, 24B, 80C can be availed individually by all the borrowers over there, right? That's the case related to. And if the property is rented out, as I told you, and particularly if the property is rented out, interest paid on the loan can be fully deducted from the income received from the property without the limit of 2 lakh or particularly 30,000 as the case may be. Okay, so that's the case related to it. Now I've already told the cases to you related to home loans in joint names. As I told you that A and B are joint borrowers. In that scenario, the deductions can be claimed individually under section 24B, 80C and 80EE. There is no condition related to same that the complete limit is over there. So there is no condition related to it. Okay. So after that, it's related to tax implications in respect of NRI home loan. NRI home loan. So NRI actually who is going to repay the home loan can avail a tax benefit. So NRI who is going to repay the home loan, they can take a tax benefit of 1.5 lakh rupees of the principal component and the 2 lakhs over the tax component as available to the Indian individuals. That benefit would be available. Condition is actually related to what? Condition is related to if the NRI's sole income is from abroad. Let's say case A is NRI who has taken a home loan facility from the bank in India, and further his whole income is actually from abroad and he is earning nothing in India. In that scenario, no benefit can be taken. In that scenario, no tax exemption can be taken, right? But if NRI is having extra taxable income from India, they can be claiming the home loan tax exemption as similar to that of the residential on individuals. Okay. So that's the case. So if the NRI is actually having the income from abroad, then no tax exemption is allowed. But if the NRI is actually having the another income from local sources, in that scenario, the tax exemption can be taken as the available to the resident individuals. Okay. Further after that, it's related to the mortgage advice. It's related to the mortgage advice. Now, mortgage advice is actually a profession. It's actually a profession which is carried out without any regulations in India over there. There is no entry barrier. There is no code of conduct that how it is to be done. There is no conditions related to any regulations over there, right? Now, first of all, it's related to the information back. Now, mortgage advice is related to that we are providing some advice to the person related to person over there. That's a mortgage advice. Let's say case there is a dealer who is advising us first to purchase this thing or something. So that's a mortgage advice over there. There is no regulation related to the same. And further, we need to understand the information pack. Now, information pack is actually related to the important collection of the data. Let's say case that you want to basically get the information. That scenario you can be taking the data from the different sources, internal sources or external sources, and the crucial information related to property which may be crucial to both the buyers and both the sellers over there. And further, that's actually related to information pack. Now, what are the components of the information pack? First of all, it's related to the compulsory documents. It's related to compulsory documents. Now, sales statement providing the basic information. It's providing the basic information related to that. If you want to basically know about the land, we want to know whether the land is freehold or whether the land is leasehold, or we want to basically know the other things about the land. So its possession is vacant or something, right? And also we want to look for the evidence of the title over there. We want to basically look for the EAG, EAC over there. Now, EAC is actually what? EAC is Energy Performance Certificate. EPC is what? EPC is Energy Performance Certificate that is to be obtained, and that is having a range from A to G. That is having a scale from A to G that is to be obtained, right? So these are some of the compulsory documents related to property. Like we want to know about the holding of the land. We want to know the title deeds over there, and further there are some optional documents also related to condition report. What is the condition of the home over there, or the legal summary related to the land over there, or home use or content forms, that for what purposes it is being used, right? So it basically provides a lot of information about the property over there. Related to information may be included related to what are the boundaries of the property, notices if any there, and for the services and sharing with the neighbors or something, right? So it may be helping the potential buyers also. So if we're talking about the information pack, we are having the two types of components. One is related to compulsory documents and the other one is related to the optional documents, right? And after that, it's related to time value of money, interest and annuities over there. Now, what do you mean by time value of money? Now, let's say case that you are having rupees 10 lakh in 2024. That 10 lakh won't be worthing the same after 10 years in 2034. That's the value of money. And also, let's say case right now I'm going to purchase some particular asset in rupees 10. After 5 years, it may not be the case I will be able to purchase the same asset in 10 rupees over there. It may be costlier because due to inflation, right? So the time is having there is time value of money. There is time value of money. So whatsoever we are having today will actually be worth less in the near future, and whatsoever we are having the in the future amount over there, that is actually worth less today. Okay, so that is the thing related to it. So whatsoever the amount we are basically having today, that will be having more value in the near future, and whatsoever we are going to get after 10 years will be having lesser value for the same. Let's say case, as I told you the example that we are going to get rupees 10 lakh after 10 years. That's that scenario. I'm going to get rupees 10 lakh after 10 years. I'm to basically discount. If I'm basically want to calculate that particular amount in today value, in the present scenario over there, I need to basically reduce that particular value over there. And how can I be reducing? I need to reduce that particular value at some discount rate. I need to discount the value at some discount rate. okay, which will be making it preferable that this is actually valuing as per today over there, right? So that's the case related to it. And what do you mean by annuity? So annuity is actually related to a regular payment or a fixed payment which is basically being received or given at a regular interval. Let's say case that we are having the timeline over here, and for the it's indicating 0, 1, 2, 3. So every month if you are paying the recurring deposit amount, or you are paying the rentals over there, so that's forming what? That's forming a annuity, because we are paying a regular amount, we are paying a fixed amount for a regular period at a regular interval, right? So we were paying rupees 10,000 for each and every month. So we were basically paying rupees 10,000 for each and every month in the RD account, right? And we are basically interested at what amount we'll be getting after 6 months or after 6 years over there, right? So we are basically interested into what? We are interested into the future value. So there are two concepts. One, it's related to present value. Let's if we want to calculate the value of these particular things in the present scenario, in that scenario I need to discount these values, as I told you in the earlier thing over here, that we need to discount the case if we want to get it into the present concern. And if we want to basically get the future value, in that scenario we will be adding some value to it, whatsoever the interest will be earning. So whenever we are discounting the thing, we basically represent the discounting rate by R, and we are earning some interest. In cases when we are earning some interest, we are going to represent it with I. We are going to represent it with I over there. Okay, is that clear? Now after that we are having the scenario related to, it may be a ordinary annuity, or it may be annuity due. It may be annuity due. So when we are talking about the annuity due, when we are talking about the annuity due, in this scenario what happens? When we are talking about the annuity due over there, in that scenario we are going to pay or receive the amount in the beginning of the period. In the beginning of the period, let's say case I'm going to pay the rent on the first of every month, that is beginning of the period. That's the case of annuity due, right? And when we are going to pay or receive the sum at the end of the interval or at the end of the period over there, that is a ordinary annuity. That is the case of the ordinary annuity, right? Is that clear? Okay, so now I'm going to tell you way that how we can be memorizing the formulas related to the same, and further it will be helping a lot. So that's to solve the questions. Okay, so first of all, it's related to the future value of ordinary annuity. It's related to future value of ordinary annuity. So it is the C into 1 plus R raised to power n minus 1 divided by, sorry, not R over here. When we are talking about the future value, we are going to add the value. So it would be the interest value. So it will be the interest value. So it is 1 plus I raised to power n minus 1 divided by I over there. This is a formula that you need to memorize. For future value of ordinary annuity, this is the formula, right? So C over here is a cash flow. Let's say case that you are going to deposit rupees 10,000 every year for the next 3 years. For the next 3 years. So this is 1, this is 2, this is 3, and this is 0, right? And you're basically interested into calculating the future value after 3 years, what you will be getting, right? Because also you will be getting, let's say case you are getting an interest of 12% per annum. Now in that scenario, C would be equal to what? C is a cash flow, which is a fixed amount, that is 10,000 rupees. That is 10,000 rupees. And what is I? I is 12%. So it is 12%. We will be converting it to decimal part. So it will be 1.12 raised to power n. Now n is actually number of terms, right? It is 3 because it is for 3 years. Minus 1 and divided by 0.12. Now when you will be solving this, you will be getting the future value. You will be getting the future value. Okay. Now what if I want to calculate the present value? What if I want to calculate the present value? Now in that scenario, you must be memorizing the formula, same formula. Just this is the first formula, and the second formula will be related to present value of the ordinary annuity. Now only one single change is to be done in this particular formula. First of all, it's related to C into 1 plus. Now in case when you are going to calculate the present value, you just need to change the I to R. There is no actual difference. Mathematically, there is no difference between I and R over there. I is interest rate, R is a discount rate. Both are rates, right? But as per the, you can say the structure we are using for calculating the present value, we represent it by R over there. Small r actually related to discount rate. So it is 1 plus R raised to power n minus 1 divided by R. Now these formulas are quite identical, and just multiplying it with 1 plus R raised to power n. That's it. That's it. And this is a present value formula for ordinary annuity. Now ordinary annuity is related to when you're going to pay or going to get the sum at the end of the interval. At the end of the interval, that's a present, that's particularly related to ordinary annuity, right? So we basically have learned two formulas so far. One is related to the future value of ordinary entity, and the second one is related to present value of ordinary entity. Now, what about the annuity due? What's about the annuity due? Let's have a look at it. Let's say the case for the third formula, you'll be simply be using the same thing. That's related to future value of annuity due. That is actually equal to C into 1 plus I raised to power n minus 1 divided by I, and further 1 plus I over here. 1 plus I over here. Now, why extra 1 plus I over here? Let me just tell you about it. So let's talk about 0, 1, 2, 3, this particular period. So it is 0, 1, 2, 3. So when actually you're going to go with the annuity due, in that scenario you're going to deposit in the beginning of the interval. Let's say case in that scenario, in case of annuity due, I'll be depositing the money over here. Let's say I'm depositing rupees 10k every year. So if it's a case of annuity due, I'm going to deposit the money over here. Then at the first year, beginning of first year, then at the beginning of second year over here, right? That will be the scenario. If I compare it with the ordinary annuity, with the same case, 0, 1, 2, 3. 0, 1, 2, 3. I'm basically considering the case of ordinary annuity. Now in that scenario, I'm going to pay the amount at the end of the interval. So it will be, going to pay over here. I'm going to pay over here, right? Is that clear? Now if we look at the picture clearly over here, if I'm talking about the interest, I'll be earning the interest in this scenario, for this period also. But for this, in the case of ordinary annuity, I'm not going to get the interest for this particular period because no money was deposited for the first thing, and I'm going to get the interest for this particular period only, right? So that's the difference between the ordinary annuity and the annuity due. That is why this extra 1 plus I is there. Getting my point clear? Okay, so that's why it was there, and that is why you need to basically write this 1 plus I at the end of the same. Okay, now let me just tell you the fourth formula that's related to the present value of annuity due. Present value of annuity due, same formula. So you'll be writing all the thing as such. C into 1 plus I raised to power, I will be, because we are going to calculate the present value, so I'll be replaced with R, right? Raised to power n minus 1 divided by R into 1 plus R raised to power n, and again 1 extra 1 plus I. That's it. So these are the four formulas that you can be memorizing from the single formula over here. From the single formula you can be memorizing the four formulas over here, right? So you need to memorize this formula, and there is another formula that you can be memorizing from the same, that's related to the EMI formula. Now this is formula, the second formula we are talking about. The second formula over here, this is actually the formula of EMI. Now EMI is actually also kind of annuity. When you're paying the EMI, you're paying at the end of the tenor. You're paying at the end of the tenor, so it's forming a ordinary annuity. It's forming an ordinary annuity, and when we are going to calculate the present value is already known. That is actually equal to what? Present value is a loan amount. It's the loan amount over there. Present value we're talking about, and C is actually related to what? C is the EMI amount that we need to calculate. C is the EMI amount that we need to calculate. So it is the same way, 1 plus R raised to power n minus 1 divided by R into 1 plus R raised to power n over here, right? So this is how we can memorizing 5 formulas from just one formula over here. Okay, so this is all the theoretical part over here. You need to not to basically going for the same, and I've already told you that how you can be calculating the same. So now let's have a look at the question over here. It says if a person is depositing rupees 20,000 per year for 5 years, for 5 years in the beginning of each year. Now when the person is saying in the beginning of each year, what does it indicate? It indicates it's a case of annuity due. It's a case of annuity due over here, right? And the person is depositing rupees 20,000. So the value of C is equal to 20,000 over here, right? And further 10% per annum. So particularly it is the interest that is given to you. How much amount will be given? How much amount will be available with him at the end of 5 years? So we are going to calculate the value after 5 years. So we are concerned about future value. So I over here is 10% and N over here is 5 over here. And we are to calculate the future value of annuity due. Future value of annuity due. Formula is C into 1 plus I raised to power n minus 1 divided by I and 1 plus I, right? So C is 20,000, 1 plus I 10%, 1.10 raised to power 5 minus 1 divided by 0.10 and further 1.10. Okay, now easily we can be solving this using the simple calculator. You are basically allowed in the exam so as to take this simple calculator. So take it along. So it is 1.1 multiplied by 1.1 and pressing the equal to sign for 4 times now. Okay, so 1, 2, 3, 4. So it is 1.61051 minus 1 divided by 0.1 multiplied by 1.1 and multiplied by 20,000. So the amount is 1,30,000. It is 134,312. 134,312. So that is the answer for this question. Okay, so that will be all for this particular video. Thank you so much, and see you again in the next video. Don't forget to subscribe to our channel, and for the do like this video, share this video among your friends and colleagues.